Hi, Ivan. How are you, buddy? Been a long time. I'm going to pass the controls over to you. I saw your tweet. Looks like you have a lot of good stuff to share with us today. So, waiting to hear your voice and see your screen, my trading warrior brother.
Hey, Dale.
Hi, Ivan. How are you, buddy?
How you doing? It's been a while.
Yeah, what, a couple years?
That's right. I remember back in the old days when we were having that interview with
on F.A.C.E Street? Are you there? We lost your voice, Ivan.
Yeah, we did lose him. Initially, I thought it was me, but yeah, we did lose him.
Adam Batten and the like.
Oh, here he is.
Oh, okay. Oh, yeah, we did some type of panel interview, didn't we? With Adam?
We were discussing how we would be working out our strategy. Remember?
You're breaking up a lot on me, Ivan.
Oh, you lost my voice?
Yeah.
Ivan, are you on a Wi-Fi?
Yeah, it was back in 2016, I believe.
Okay. Well, you're coming in and out. It's great to have you back. And tell me.
Connect my VPS, see if that helped.
Okay, that's better.
Is it better now?
Yeah, much better. Okay, so it was 2016 we did a panel, or what was it?
Okay, listen, you got any issues, just stop me.
All right, you're breaking up again.
Back in 2016, we ran the FX4 forecast, I believe.
Okay. Yeah, we're having trouble with your audio today.
Okay, allow me.
You're cutting in and out.
It's quite shocking because I didn't have any issues throughout the day. It just happened
now
to be
you're okay.
Right now while I'm having a chat with you guys. Okay.
Okay.
Well, let's give it a try one more time. Otherwise, I'm gonna be switching on and off my Wi-Fi and see if that works. It'll take a minute.
Ivan, because I have some experience. I had some issues. Do you have a VPN?
I just happened to disconnect the VPN, so hopefully that will help.
Okay, because we can hear you perfectly. Yeah, you sound perfectly now. So perhaps that was the issue.
Excellent. I'm sorry, guys.
Let's see how it goes.
That's okay. That's okay, Ivan. The point is, you're here. We're talking. You have some charts up. Why don't we talk about what you're doing, where you're working now, and who you're collaborating with and helping nowadays?
Absolutely. Can you see my screens first of all?
Got it. We have the S&P and the gold underneath
and you sound perfectly now, so it's okay.
Excellent. Okay. Well, I was the chief editor at FX Street for over 10 years. I spearheaded the strategic planning and the editorial responsibilities up to December 2017. And then I transitioned. I went on a little bit of a sabbatical, went off the grid for a while. And since last August, I have joined a new, I've commenced a new tenure, this time at representing Global Prime, an Australian regulated broker. And yeah, I mean, for the audience, those that don't know me, not familiar with who I am, my profile, been trading and providing expert analysis for over a decade and capital markets. I've been interacting for many years with, and nurturing some top-notch contacts at an institutional level while I was trading at FX Street. That has really boosted my understanding and knowledge of the markets. And nowadays, what I'm doing is my whole purpose is really, I'm on a mission to pass my knowledge about the markets, no filler, no nonsense, trying to deliver as much value as possible. I am looking at cycles, volumes, levels. I'm looking at the intrinsic valuations or correlations and how we can perhaps find those value trades as well. And I am delivering all this content to both Global Prime clients and those that might potentially be the prospects joining us in this journey. And
well,
as I said,
congratulations.
Yeah, it's I found that
you're a mentor analyst. You moved from the strictly content side to sharing the knowledge you gathered during all those years at FX
I felt that my position back at FX, it was excessively editorial in nature, and it wasn't really, I wasn't maximizing my capacity. I wasn't exploiting my capacity, wasn't shining as much as I can potentially do so. And now I feel blessed by Global Prime providing me the platform where I produce tutorials for customers, both at a retail and at an institutional level. I am delivering a daily analysis, studies of the charts. I go through my own proprietary risk models, so to understand what kind of risk conditions we are having in the next 24 hours, potentially based on structures. And then I'm looking at volumes, cycles, correlations. Imagine, for instance, if we are going to be trading euro dollar, you definitely want to be paying attention. What's the Italian premium? What is the German versus the Italian 10-year yield spread? Is it continuously going lower or is it correcting higher? That's going to help us to understand whether or not the euro will justify potentially, if we happen to trade at a certain level, a potential bounce. That's something that I'd like to walk you guys through today.
Okay, that'd be great. So
sure.
where do you access the yield spread on Italian bonds, and you know, what tells you when things are going to be heightened, certain levels, or just a trend of the widening of rates between Italy and, say, Germany?
Yeah.
Or US.
So I utilize TradingView. As you probably know, this is the most accessible platform for those that cannot afford Bloomberg's or the likes, like Reuters Icon. So this is the one that I'm using. And before I really want to set up a little bit of a foundation for those that are listening today, as a trader, you must always be aware that there is this myriad of factors having an impact in the value of a particular currency. You know, it goes from capital flows a country is importing via its equity market, the seek for higher returns on sovereign bonds, fundamental reasons based on economic data or politics even. For example, last year, we saw a massive divergence in the euro. Let me just show you the euro dollar here in a second. I'll find you, there's one chart that I want to show you to start with. Let's see, can I find it? Must be, anyway, last year we saw the major yield spread divergence on the back of the French elections. And that was a political driven event. And that actually was a very sentimental led event. Okay, these are the charts, I believe. Let's see.
Yeah, we left a gap and never looked back for quite some time.
Let me just open so many windows trying to find the one that I want to show you first. Let's see. Don't even know if it's here anymore. Anyway, let's start by, what if I start by showing the risk model that I monitor very first thing every morning?
Sure, buddy.
Excellent.
It's your interview.
Yeah. So basically every single morning, whenever I wake up, I want to first of all incorporate within my studies, what is the context, what are the conditions that we are facing. And for that, you can see here on the bottom right side of my screen, I have what I call the risk sentiment scenarios. So based on the different combinations, here you can see I have up to 6 different columns. So we have equities. So the representation of equities through the European session would be the STOXX 50 or the DAX. They are strongly correlated with each other. And then we would have the S&P 500 that, as we see, we're breaking through this descending trend line in the US session. Now we have the US 30-year yield. That's a great proxy to understand risk on or risk off as well, especially when combined, as I said, with the equities and the dollar index. So when we combine
UND mean up and down, Ivan? UND?
That's right.
Letters, okay.
Otherwise, wouldn't really fit within this 6 screen panel.
So you have risk on in the first column, even though you have, well, you have the dollar down, but the dollar's up. Maybe it was
So the
down
first
early.
column,
Okay.
the first column is what I would call extreme risk on conditions, or textbook risk on conditions. That is when the S&P 500, in the case of trading American session, and the US yields are moving in the same direction, going up. And then you obviously see pressure coming down the US dollar. Now we're starting to see a little bit of a paradigm shift where the US dollar, even though it's a high yielding currency, is still acting really well when it comes to risk aversion phases, So in these kind of conditions, it's unambiguous. The risk appetite conditions are going to be present in the market. We're going to see the market emboldened with a sense of kind of optimism, even grit. And participants are going to be looking at selling the Japanese yen, the US dollar, not so much the Swiss franc. Swiss franc, it's a bit more tricky to trade these days. It's not behaving as the typical risk aversion currency as it used to be. It's a bit more piggybacking the euro these days, the Swiss franc. So kind of like this environment is keeping a bit tone in commodity currency.
Why do you think that's happening? Why do you think that's happening? The Swiss is acting that way.
I don't trade the Swiss actively, and
okay.
in my opinion, I don't think there is a justification I can think of other than this paradigm shift where we just came from an era of Kiwi easing, and now we are kind of starting to move towards this transition of Kiwi tightening. And I think that there is this underlying risk in Europe where you have Brexit and the exposure, that risk that is emanating out of Brexit, and you also have the Italian situation. And to a greater or lesser extent, Switzerland might be also in the mix. And who knows if that might be one of the reasons why the Swiss franc is not acting as it used to be. Not sure if you have a thought there, which I could learn from too.
I don't. I actually stopped really trading it after the depegging, long time ago. I watch it, but I was just curious that you're not getting any flight to quality in it when the market's under pressure.
Yeah. So second column we have.
Go ahead.
Second column, allow me to just continue so we can continuously kind of deliver this value to the audience. So second column, we have when equities go down, US 30-year bond yield goes up, and then we also have that pressure on the dollar index. So in this kind of scenario, the selling of the US dollar and the US bonds, in other words, the higher yields, despite the lower S&P 500, this is kind of a sign that the overall risk environment is still supportive. And somehow the conviction to buy risk currencies, the Aussie, the Kiwi, the Canadian, is not as high. And this scenario obviously would negate if the decline in the S&P 500 is sudden and sharp in nature, but it's one that I still consider to be risk on. And I will assess this based on the structures that I'm seeing. So for example, why did I highlight the column 5 today? Well, because we are in an environment of US dollar strength dominated by higher yields and higher dollar index. So here, why did I write UD? Meaning that when this is the environment that we are faced with, then we need to find some cues out of equities. If equities are breaking higher, this suggests that the overall risk environment is going to be still friendly. It's going to be still constructive to support, especially Japanese yen crosses and the likes of potentially the Aussie. We need to look at the correlations later to understand what would be the outlook. So what do we have today? We have the S&P 500 breaking this descending trend line, and we seem to be now, as we speak, about to find this, what I'm looking for in this hourly chart is a couple of hours of acceptance. If we find that acceptance above this previous swing high, and notice how we have these clusters, and we're coming on the back of this, what I call compression structure. So whenever we have these compression structures, this communicates two things. Number one is either sellers are taking profits off the table, there's not so much conviction, or we might be potentially building some long side action campaign in the very short term. But nevertheless, I pay attention to the structures. So we're having an S&P 500 breaking higher. The Stocks 50 was a front runner, broke actually before the S&P 500. So that to me was a tip yesterday in the European session. As the dollar index was breaking higher, we already had seen this break of the descending trend line. And now we've been buying the dip here. Now we had also this break of the US 30-year bond yield. This descending trend line was determining to me whether or not we would have the foundation to actually build higher highs on the US 30-year bond yield. If that's the case, then it would go full circle on having an environment, especially obviously breaking here the dollar index, an environment of US dollar strength. Then we would have to find the cues through the equities. So first building blocks of the day before sending over the rest of the content to the clients is, what is the context? Are we going to find risk aversion or not? Are we going to find the market that is conducive to your strategies or not? That is the number one foundation that everyone needs to understand in the markets. And after that, we dive into, for instance, let's dive into the euro dollar. For me, it's very important that we have this, what I call, don't lose sight of the forest for the trees. Let's always pay attention, first of all, at the multi-time frame. The sequence of time frames that I always like to see, and I personally trade, is I pay attention to the weekly, the daily, the hourly chart, and then on the bottom right-hand side, you will notice I have also the daily, but here is where I pay attention to the yield spreads. And I'm not sure if I have to go through this one, but this is the correlation coefficient. So basically the blue line is communicating that right now on the daily 30-day period, we are having a positive correlation as it's expected with the German versus the US yield spread, and same applies with the Italian, even though the correlation's been dropping a little bit. The one that I really wanted to show you, just to take home how relevant these yield spreads are, is the 3-day. So allow me just to show you the 3-day. Let's move into, because I think I lost that window. For some reason, I closed it. So if we were to actually look at the 3-day, 30-day period correlation on the euro dollar, if it loads at all, it's going to take more than 10 seconds and it gets stuck. Let's move into the pound. It sometimes happens. Let's reload. Let's see. Okay. Apologize, buddy.
It's okay, partner.
Let's see.
Okay.
3 days. Was it this one? Oh, this is the one I wanted to show you. Got it. Okay. So this is the yield spread, German versus US, on a 3-day chart. This is a 3-day chart, and this is a 30 period. This is one of the correlations that a bank, the likes of Nomura, follows on a regular basis. And this is communicating how much of a lead you can take when following the German versus US yield spread when trading the euro, and at the same time notice how much of a relevance and importance the Italian premium versus the German is had. This magenta line is the German versus the Italian 10-year yield spread. So by understanding this type of correlations, you can form an opinion as well when trading the euro. And let me then now take you back to the chart that I was supposed to show you in the first place. So this is the chart of the euro. So first of all, what I'm looking at is the weekly. The weekly, I find my perception is that we had this monstrous ride to the upside, and we found acceptance mid last year, and ever since we had a correction. The correction went to the 50% retracement of this move, and notice how much of a confluence it was. I mean, it was a major sticky support. It has become a very sticky support. Now, we have rebounded, and we found a double top right there. Notice how it acted as resistance, and now it's acting again. So whenever I see these conditions, if we are to see a 50% retracement back to the previous swing low, then to me, the market transitions into a range until confirmation of a new low. So to me, now we're still in a range, but we're in danger ahead of the US NFP on Friday. If we find another close below this 50% Fibonacci retracement, and most importantly, if we can close on the weekly below this previous swing, validated swing low, what I call, then we might actually see the kind of long-term target in the euro really evolving towards 1.0845. That's my 100% Fibonacci projection target. That's how I call it. And obviously very much dependable to the outcome of the US midterm elections in, I believe it's 8 calendar days ahead. That's going to be obviously leading up to a reassessment, reevaluation of positionings. So you always obviously have to pay attention to this fundamentals, especially these kind of major risk events. Now, looking at the daily, I'm always paying attention here at the same things, cycles and levels. On the daily, we have a down cycle, and we are evolving in a conducive manner to target the next 100% Fibonacci projection, which, as per my calculations, it would come at 1.1242. So that's the target for the daily on the euro dollar. That's the one that I see based on drawing a Fibonacci that goes from the previous validated swing high through the breakout point. So that gives me a projection 1-to-1 or 100% of 1.1242. Now, looking at the hourly, on the hourly we had this break of a descending trend line, and whenever that happens within a trend, that starts to give me more caution, and I'm starting to call it a poor quality downtrend, even though still didn't take out these highs. Therefore, we were not transitioning into a high cycle. And notice that my structures, my cycles, always orbit around the 50% level. There are many that are going to be applying Fibonacci's of 23, 38.2, 68, 61.8, etc. I only use the 50% to determine the formations of my structures and whether or not we see a bounce or a pullback that is strong enough to make it to the 50% retracement of the previous validated swing high that I mark in my charts or not. And the 70% retracement within a trend, that's the area where I tend to enter trades. I'll give you an example in a minute where I tend to enter trades, and one of the latest trades that I'm in the Aussie against the US dollar, long position filled after today's Australian CPI headline. A little bit of a softish, missing expectations there, got me feel long, even though I'm not really confident on the Aussie breaking much higher. So now we're seeing the euro dollar breaking lower, and if we find acceptance, couple of candles below this previous validated swing low, we are going to be confirming a new cycle low. So that would allow me to then extend. This is something that I do every single day manually, and I do it through MetaTrader. But for the purpose of showing you the yield spreads and other components, I'm just going through TradingView. So we're about to produce a new cycle low. And this is the very last component that I go through and I try to gauge the direction. And here I monitor, and allow me to maximize this chart for a second. Here what I do is, on top of the cycles that I just went through, top-down analysis, I pay attention to number one, volumes, and number two is the correlations. We've already seen that the correlations are a great leading indicator, especially at certain levels. So here, earlier this morning, when I woke up, I saw that, sorry, this is the 3-day. Let me go back to the daily. One sec. Okay. So this is the daily. Early this morning, when I woke up, we had these two candles that were about to negate this rebound, this green candle, of this support. If I were to minimize, remember, I always have these levels marked. So this is the support that I mentioned right there. So after this support, it was suggesting the market that not yet the cycles were starting to create higher highs, but it was an early warning. Not that it would produce any trade based on my own personal trading approach either, because I need to see higher highs, new cycle highs, but it was an early warning. Now, after these two closes, I have several tips that I can find from the charts. Number one is, even though we're going lower on a tapering of volume. I pay attention to tick volume. Not sure if as part of analytics, you
what's
guys
the message? What's the message behind a market going down on lighter volume?
Exhaustion.
Okay.
Exhaustion, but doesn't mean that it's not going to stop going lower. It's just giving you an idea. It's just giving you an idea that the market might be exhausting. But first, you might want to be paying attention to where the POC is from the previous day. I have a markup. It just keeps reloading my charts, and now the POC disappeared. But you really need to have some evidence before the exhaustion takes place. After the exhaustion takes place, I mean, otherwise,
like a reversal candle or something like that, at least.
At least, well, in my preference, I would like the POC to be retaken. So if we were to pay attention to where yesterday's POC is, it's this indicator BPSV, and since I just got the chart reloading, it still shows loading. So let's just be patient until it comes to the chart. But I believe yesterday's POC was about, if I'm not mistaken, from today, about 1.1370 or thereabouts. So I would like to find acceptance, like finding equilibrium above that point would suggest that not only we found acceptance, we found tapering of volume on it, which suggests exhaustion, but we are also having that commitment back from buyers. So that's one of the clues that you can be looking into. A second clue is, are we going lower and in line with the correlations, or are the correlations suggesting that this is a low not being justified? Sometimes you will have a detachment of these correlations and the price just keeps going lower. So
they disconnect.
And why I pay attention here is the following. I'm trying to find in the charts levels of reference. For example, where was the where was the German versus US yield spread? The last time that we touched this level, where were they trading? So we were to find this level of reference. It's right here. It's on August the 15th. This is just one way of actually trying to work out and figure out what is the actual valuations of these markets. So we were trading at August 15 at these levels. Now we are trading lower, and we seem to be right around the same levels, but we are having a little bit more of a sharp fall in both the German, US, and the German versus the Italian. So that's suggesting that the risk, considering in a holistic approach, remember, when I put my content together, I always suggest clients, you need to kind of have this holistic approach, be pragmatic, and pay attention to every single analysis that I make, both on cycles, levels, and then you can form your opinion. It is very clear to me how I trade the markets. To me, cycles rule anything else. But if I find that there is all the stars, the rest of the stars are aligning, then it will allow me to have a greater or lesser allocation in terms of my risk. I might actually go 1% risk, I might go 2% risk. It will also depend on the time frame that I'm trading. So that is the picture that I present to the clients, and you can see today's report, for example, here. So this is FX majors, analysis on cycles, volumes, correlations, and levels, looking into the risk sentiment model, and then we go through FX majors. So we're looking into euro-dollar, analysis of the cycles, correlations, the set, what are the drivers, and what are the risk sentiments for the next 24 hours, so that to understand this overall view of the market.
Do people have to have an account with Global Prime to get your research?
No, they don't. It's freely available for every single one that wishes to follow me.
Okay. So all they have to do is go to Global Prime's website and keep in touch with what you're thinking, and they can learn from you.
Exactly. And we now have a temporary block. It's called, well, it's here in Medium, medium.com at Global Prime Forex. We are about to go through a revamp of the website. It's just a 1 month away, maximum 2 months away. And once that is established, once that new website is up and running, I'm going to be able to put all this content together through the new website. For now, I am producing also tutorials, so looking at how to interpret volume profiles, structures, what I call the magic of this 100 Fibonacci projection, why tick volume is important. People can visit this blog and gain a deeper grasp, understanding about different knowledge that I've gathered over the years. So,
well, Ivan, I want to wish you tremendous success with your new position, and your passion is obvious, and also your courage for making change. A lot of people get comfortable after 10 years somewhere, and if you're not growing, you're dying, and you stretched yourself to do this, and I'm rooting for you. And anyone who was viewing this knows where they could keep in touch with Ivan. On Twitter, your Twitter handle has a little underscore on it, but it's Ivan Delgado _EGEA, and you could find him at www.globalprime.com, correct?
yeah, the Twitter is at Delgado _EGEA. Yeah, that's the Twitter account, and they can find us. They can find us in globalprime.com.au, and just be reminded that Global Prime is one of the top most rated brokerage firms in Forex Biz Army, and that speaks volumes about how we want to care about the customers as first and foremost. So
and,
yeah, that's
everyone can open an account with them except U.S. citizens, right?
That's right.
You take Europeans, you take people from everywhere, but good old God bless America, right?
That's right. Not
okay.
not that I'm making the rules myself.
I know, Ivan. I know. we've got leprosy. It's called regulation. And you guys are regulated by who in Australia? Your regulators are who?
By the ASIC.
Okay. Well, God, it was great talking to you, buddy. And I wish I had talked to you more when I was at FX Street. You really look at everything. So best of luck, good hunting, my trading warrior brother, and thanks for taking some time out to address our community today, Ivan.
My pleasure.
I thank you for everyone.
Better, but I understand time is limited.
Thank you so much, Ivan. Good hunting. And that's a wrap for us today, everybody. See everyone tomorrow on Thursday. Going to have Callum Thomas with us tomorrow. And enjoy the rest of your day. See you in private members chat. And most of all, don't just count your pips, count your blessings. See everyone tomorrow. Adios.
See you. Cheers.
Cheers, Ivan.